In this video, I'll take you through the difference between the three methods that are used for assessing working capital. One is turnover method, the other one is stand-in committee method, and the third one is cash budget method. In turnover method, the working capital requirement which bank can finance is considered as 20% of estimated turnover. Under stand-in committee method, there are two sub-methods, that is method 1 and method 2. Method 1 says from total current asset, we have to deduct other current liabilities excluding bank borrowings. We arrive at working capital gap, and this working capital gap have to be funded by the borrower to the extent of 25% of the gap. It means only for the balance the bank finance can come into picture, that is eligible bank finance. This is method 1. Method 2 says total current asset deducted by other current liability excluding bank borrowing, you get a working capital gap. This working capital gap have to be funded by the borrower to the extent of 25% of current asset. Here it is 25% of the gap, but here it is 25% of the total current assets, and only for the balance bank can come into picture. This is eligible bank finance. And this cash budget method actually focuses or compares the cash receipts, cash payments, then it will identify what is the shortage. So it is the shortage that got to be funded. So the cash receipts will factor all the receipts that are arising on account of sales, realization from customers. Cash payments will factor all the payments to suppliers, all expenses, everything. Then there will be a shortage. Now this shortage can be funded by the banks, and borrower also have to contribute. So there will be a margin stipulation, and the balance will be the eligible bank finance. Okay. So the method 1 is a straightforward method, and it does not look into what is the actual scenario of the borrower. Okay, it says 20% of the estimated turnover is the eligible bank limit. It means this 20% of the estimated turnover may meet the requirement, so it may be sufficient, or sometimes it may be excess financing, or sometimes it may be under financing also. So this method operates on the premise that a business is having a 90 days cycle. It means they will have 4 cycle in a year, and for that, for supporting each cycle, they will be requiring 20% of the turnover as the working capital finance. This is the assumption under method 1. This stand-in committee is even more practical because it considers what is the actual cycle. What is the actual cycle? Here there is an inherent assumption that this business is going to have 4 cycles. But stand-in committee says look at their actual cycle and fund accordingly. And the third method, cash budget, is not concerned about cycle. It is concerned about actual inflows and outflows. If you ask me which is the most appropriate method, I would say it is cash budget method, because it's going to capture realistic scenario. This tandem committee method, turnover method is what in practice, but we will see the days where banks will switch over to cash budget method, which actually foreign banks are doing already, and some of the Indian banks have started embracing this as well.